Bitcoin has officially had its second worst day of the year, plunging to just under $100,000 yet again. And you can picture the headlines right now screaming Bitcoin crashes to a measly 100 grand. The doomers are setting their hair on fire. CNBC is dusting off the panic graphics as we speak. But we need to freeze the frame because right now behind the curtain, the money spigots are cranking open right now. The Fed is stalling quantitative tightening. The ONRRP cash pile is leaking into the banking veins. China is firing another triple R bazooka, and the stablecoins print digital dollars faster than Starbucks lattes. Liquidity is the oxygen of every single Bitcoin price mania, and we are about to breathe in very deep here. So before you mourn a six-figure Bitcoin right now, I need you to remember that every past flood of fresh capital has been a launchpad and not a tombstone. And today I'm going to decode exactly how this tidal wave can shove price discovery into uncharted orbit. So this is the snapshot right now. We need to talk liquidity returns. The Fed is slamming the brakes on quantitative tightening. The ONRRP cash pit is coughing up its last pennies. Beijing is priming their economy with fresh Swan, and stablecoin printers are humming louder than a Boeing turbine right now. For the first time literally since 2021, the money tide is turning. And when we look at the available firepower, my conservative math is tallying $1.3 trillion of fresh fuel over the next 12 months. And then when you factor in new bank leverage relief and a reboot of ETF inflows, and the pool will swell toward perhaps $2 trillion, and that is the GDP of Italy that is looking for a home. And historically, Bitcoin has always soaked up the excess liquidity like a desert soaks up rain. Across the past 3 liquidity waves, every single 1% uptick in the global liquidity index translates to about 0.8% appreciation in Bitcoin over the next 18 months. And this relationship is stubborn, it's reliable, and it's brutally simple. More oxygen means a hotter fire for Bitcoin. So if you run today's liquidity trajectory through that beta, and the base case lands at 140 to 160,000 Bitcoin by the fourth quarter of 2026. But if you layer on the bank balance sheet deployment plus a steady ETF bid, and the high conviction range stretches from 180,000 to 220,000 Bitcoin, and this is not hopium, this is just the historical elasticity painted forward. So the bottom line is that right now the liquidity taps are turning, the dry powder is massive, and Bitcoin is positioned to become the primary pressure release valve. So now it's time to unpack the fire hose that's about to drench the global markets. Number one, we're going to talk about the driver of the Fed stopping quantitative tightening. $95 billion a month in bond runoffs vanishes from December, the reinvestment restarts, and then this once towering overnight reverse repo pile drains from $2.2 trillion to $10 billion. The last $150 billion is poised to spill into bank reserves, which fertilizes risk appetite. And then we have to look at the ESLR relief. Regulators are loosening leverage rules for big US banks as we speak. Realistically, $185 billion of fresh balance sheet capacity will emerge, which is ready to hunt for yield, and Bitcoin is the apex predator of yield per unit risk once money leaves the vault. And then we look over to Beijing. They just fired a 0.5% reserve ratio cut, which is about $139 billion, and that signals just more easing. Chinese liquidity often finds a way into hard cap assets when domestic growth sputters. We've seen the gold run up. We have seen them buy a lot of gold lately if you've been paying attention. And then we've been having tremendous levels of stablecoin growth itself. Crypto native dollars have punched through a $300 billion cap and are growing 3.6% per month. If you add another 50 billion as the base case pipeline for on-chain powder, well, that's another bullish signal. And then if you look at the spot ETF flows, even after a very choppy October, the spot ETFs still hold a net $37 billion year to date, despite the October outflows. So if you put all of the conservative pieces together, that's how you reach the $1.3 trillion number, which is the fresh liquidity over the next year. And then if you layer on 40% of the new bank headroom and a revived ETF bid, the pool could swell to $2 trillion. So right now, the market is literally standing on the largest capital wave since 2020, and Bitcoin is built to surf it. And this is the engine under the hood that I am using. We're tracking the central bank balance sheets, the private sector collateral flows, and the crypto native dollar supply, all of these different things. And then I am adding them up in US dollar terms, and I I am getting the global liquidity index, the heartbeat that drives every single risk asset pump. So these are the key components, but the proof is in the pudding. So no, I'm not just making things up because I am back testing to 2012. And this composite explains 78% of Bitcoin's 18-month price variance. That beats raw M2, crushes the S&P 500 beta models, and it leaves sentiment gauges in the dust completely. So when the next $1 trillion floods these pipes that I'm talking about, my little tracker here is not guessing. It is measuring a GLI spike of only 10% historically, aligns with a 40 to 50% Bitcoin surge. The model says that the fuse is lit, the variance explained tells us the blast radius, and the liquidity math points straight at higher highs for Bitcoin. Now it's time to translate my theory into the hard evidence, okay? We're gonna look at the 3 liquidity waves here on the left. During QE in 2012 and 2013, global liquidity rose about 11%, and Bitcoin exploded from $12 to roughly $1,150, which was a life-changing 9,483% move, beta 0.86. And then the pandemic QE was even bigger. Liquidity went up 38%, and we're all still feeling the inflation from that great era that we all remember so fondly. And Bitcoin jumped more than 11 times from 5,200 to 63,000, and the beta was 0.78. Even the modest March 2023 bank backstop, we saw the GLI up 2%, still lifted Bitcoin up 50% from 20 to 30,000, the beta 0.79. So if you average just these 3 liquidity waves, you get an average beta of a 0.8. The R squared at 0.64 tells us that nearly 2/3 of Bitcoin's 18-month price action is explained by liquidity alone. And the plus minus 900 standard error gives us tight confidence that this relationship is very real and not random. So when I say 1% more oxygen in the global financial system buys roughly 0.8% more Bitcoin price over the next year and a half, I am just quoting history and not hopium. If you apply that coefficient to the incoming $1.3 to $2 trillion liquidity surge that I just mapped out, you will understand why 6-figure Bitcoin is the statistical base case. And there's plenty of room for a rocket ride if the upper end of the liquidity fire hose materializes. And here is my crystal ball quantified, the fun, exciting slide. Base scenario, I have the liquidity adding $1.3 trillion with an implied BTC price target of $145,000 per coin. This is the statistical middle lane, and that's already an all-time high. The bull scenario is the same foundation, plus the big banks actually putting 40% of their fresh ESLR deployment headroom to work, and the ETFs start to soak up about $1 billion a week again. The outcome range that I have is 190,000 to 220,000 per coin, which would be a double from here on disciplined capital flows alone. And then there's an obvious blow-off scenario where a bunch of liquidity floods the system. Think $2 trillion liquidity baseline, then some shock event which forces the Fed back into outright asset purchases. Think surprise recession or systemic wobble. We would just need liquidity to just rocket past the $2 trillion, and beta would literally just do its job, which would push 250,000 Bitcoin and beyond, which is a parabolic endpoint, obviously, where the media would scream bubble right before the price discovery. Gravity's much higher. And this is the great thing. Even my bear scenario is incredibly unrealistic in my humble opinion. It would imagine quantitative tightening reaccelerating, but that is not what the Fed is signaling. And it's also assuming that the ETF demand would just totally vanish. So I really think that we are at a floor in the 95,000 to 110,000 right now. Even the bearish tape still holds 6-figure support because supply is capped, and remember, the liquidity never fully shuts off. Now let's zoom in on the 3 turbo buttons that would amplify the base liquidity story. Number 1 is the ETF flow impulse. Think of ETFs as the regulated vacuum cleaner on Wall Street's trading floor. Every single time that hose pulls in a net $10 billion, that statistically adds 3% to the Bitcoin price, which is independent of the global liquidity index. A steady billion a week for a full quarter is already 12 billion, which is good for an extra 3 to 4% kicker on top of any macro move. And you got to remember the stablecoin elasticity as well, because they are the digital bloodstream of the crypto industry. For every fresh dollar of USDT or USDC minted, 60 to 80 cents finds its way into the Bitcoin order book within 30 days. So the supply curve is already bending upward 3% month on month. If you give that trend another 12 more months, that means that you're layering another $50 to $60 billion of purchasing power onto spot markets. A direct bid that statistics say pushes price multiples times higher than the headline dollar amount. And remember, Michael Saylor's out here saying, hey, I'm hearing rumors that the big banks are going to be buying Bitcoin in the first half of 2026. So think of the bank uptake on that, okay? A single digit slice of that directed at Bitcoin delivers an outsized punch because of the asset's fixed supply and the incredible capital that the banks command. So if you stack all of these three levers on top of that $1.3 trillion base, you can kind of start to see why my model keeps nudging the high six-figure price targets higher. ETFs are the ignition, stablecoins are the fuel line, and the bank balance sheets are going to be the afterburner going into the new year. And once they all fire in sequence, the upside becomes not just profitable, but statistically aggressive. Now, there are several macroeconomic factors that could offset or diminish the positive liquidity impact on Bitcoin prices. Number one would be renewed dollar strength. A surging DXY could blunt the foreign central bank easing in local currency terms, which would shrink the effective global liquidity pool. Now, I don't see this happening necessarily because if you didn't know, this is the worst year for the DXY index in recent memory. I can't remember, maybe the worst year in the last 30 years. But hey, remember, it's always a possibility. But we know that the money printer going on means that there's more dollars, which means the less value of them. There could be a treasury supply glut as well. Every basis point back up in the long bond yields pushes the allocators to evaluate alternative stores of value that are duration agnostic, which is Bitcoin's lane. So if the supply overwhelms the demand, the Fed's reserve management tools often re-enter the conversation, adding back the same reserves that were drained. And there could be a macro shock, some sudden inflation surprise, or geopolitical hit, some black swan scenario. Ironically, the shocks that threaten growth usually become the trigger for a coordinated liquidity wave bigger than the one that I even modeled, as seen in March 2020 and March 2023. And at the end of the day, Bitcoin's fixed supply narrative shines brightest when the policymakers are forced into excess stimulus, so the risk, while real, is really double-edged in the long run. And this is the cockpit dashboard that you can just track every single week to stay on the right side of the trade. The Fed balance sheet, a weekly jump of $50 billion means that reserves are rising, and then the risk lights turn green. A drain of $25 billion or worse is an early storm cloud. Lighten exposure if it persists. This is not financial advice, this is financial entertainment, but I am giving you the warning signs. And then when the overnight repo barrel falls below $20 billion, the cash is back in the banking system, and Bitcoin typically breathes higher within days. A spike above $200 billion signals that liquidity is being parked, so curb enthusiasm until that reverses. And then you have the stablecoin cap triggers, the ETF net inflows that we went over, and then the Chinese currency liquidity as well. These are some metrics that you can track that mark the bear threshold breaches, and you can adjust your positioning proactively. However, in my opinion, it's stupid to sell your Bitcoin. This is disciplined data watching, but you know what? At the end of the day, Bitcoin is kind of designed to go up because it has a fixed denominator, okay? And we all know that the money printer must print because the United States definitely needs to devalue that ever-growing national debt. So you could keep this dashboard updated weekly, you could stay nimble, but I'm just saying you can let the liquidity tell you when to press the accelerator, and there are some great catalysts lining up. Bottom line, even a conservative liquidity add near $1 trillion historically reignites Bitcoin bull cycles. So yes, we did see a bad day in the Bitcoin price action, but if you look at the convergence of all of the liquidity variables coming together, from the obvious Federal Reserve policy shifts to the crypto native dollar expansion, this is creating a uniquely favorable environment for Bitcoin appreciation through 2026. I'm looking at the regulatory tailwinds. Bitcoin is being accepted. It's being legislated on. The banks are starting to accept it as collateral. I can be nothing but bullish on Bitcoin long term. And if you're watching this thinking, I want exposure before this shift happens, well, now is the time to do it the right way. The Swan private team works with high net worth families, individuals, and companies who want to build generational Bitcoin positions safely, securely, and strategically. We help clients understand the macro forces driving this transition and how to own real Bitcoin and not paper IOUs. Because the goal isn't to trade the next crash, it is to survive and thrive through all of them. Visit swan.com/no-second-best for more. And subscribe to the channel if you want more daily Bitcoin videos during the greatest wealth transfer in the history of humanity. My name name is Adam Livingston. Have a terrific day. Do not party too hard. Class dismissed.